So as Dmitry suggested, this is a paper about new kind of option, and it invents a novel family of derivatives. I call them crossover options. You will see in a minute why. But basically, this family has some very remarkable properties. I will tell you that you can use crossover options to trade volatility. This concept could be robustly replicated in completely model-free setting. Importantly, the class of crossover options is quite general, and as a special case, it includes vanilla options, standard puts and calls. So if you're not interested in exotics, I promise you that the theoretical insights that I get by studying this general class of crossover options will be useful for your research if you're only interested in standard options. So I derived several new theoretical results which apply to standard puts and calls. I will show you a previously unrecognized replication strategy for long-term vanilla options, some new fundamental decomposition of the premium of the vanilla option into two parts, one due to continuous moves and one due to jumps. And I think there are a lot of potential application, both for academics and practitioners. So by the time I'm done today, you will all wonder how you lived your life without knowing anything about crossover options. And I think in a few years, some of you will trade them, some of you will teach them, some of you will use them in your academic research. So having set expectations sufficiently high, let me introduce this new guy. So it's a standard setup, frictionless arbitrage-free market with a single risky asset. I will work with forward price F. It will allow me to ignore dividends and risk-free rate. Trading will be discrete, and tau represents n trading dates. So think of them like months, days, maybe minutes. So this monitoring partition doesn't have to be uniform, and delta t doesn't have to be small. And it is convenient to use this notation M to denote the out of the money option with a given strike. So for any given K, there are two European options, put and call, and one of them currently out of the money. So that one will be denoted M. Okay, so now this is the formula which defines the new option. Crossover option at maturity time capital T has a payoff pi, which depends on two things: the strike or barrier K and this monitoring partition tau. And this is a sum of several terms. It looks complicated. I will show you a picture. It's actually quite simple. So B, it's a binary indicator variable 0, 1, which indicates whether on given interval the barrier was crossed over from top or from the bottom. And then if we cross the barrier, we multiply by this distance. So absolute value of distance between the price and the barrier K. So again, there is some math, but basically what I want to say that B is equal to 1 when the initial value and the final value of underlying for given interval on the opposite sides of the barrier. So as I said, it's much easier to illustrate this option with the picture. So let's say we have maturity 1 year. The underlying starts at 1 and the barrier is 5% below. We use monthly frequency. So basically we'll have 12 monthly periods over the life of the option. And we look at those 12 periods and see when the barrier is breached, is crossed. So there are 3 periods like this. They are shaded. So we go from here to here, from here to here, etc. So in those three cases, we increase the payoff function phi, and the red stem, red bar, represents this distance, this overshoot from the barrier. So the payoff phi simply equal to the sum of these three red stems. And the right panel, it shows how the payoff accumulates. So it's a increasing pure jump process, which jumps every time when we cross the barrier. Okay, so this is the definition, and next figure shows how the payoff of crossover option depends on monitoring partition tau. It continues the previous example, so we still have this 1 year option with barrier at 0.95, but now delta t is 1 year, 1 month, 1 day, and 1 hour. So naturally, as we increase the number of periods, there are more opportunities to cross the barrier, so we have more crossings, but those overshoots become smaller. In fact, in the limit, if it's continuous process, we will have infinitely many crossings, but those red stems will shrink to 0. The sum will be still finite. Also notice that the very first panel, which corresponds to the most extreme case, the lowest possible frequency, corresponds to regular option. So here, if we cross the barrier, we have only one opportunity. The payoff is equal to the difference, strike minus price. And if we don't cross the barrier, the payoff is 0. So it's precisely what out of the money put option, vanilla put option would pay. So basically what it says that on one extreme, if we look at the lowest possible frequency, we have regular put option. At the other extreme, at the highest possible frequency, we have a contract which pays volatility along strike. So it accumulates volatility along this particular level, 0.95. And we have other possibilities, something in between. Okay, so this picture shows how the payoff accumulates over time. And again, here we have only one crossing, 3, 17, 55. So again, as we start to have frequency higher and higher, this process will look more and more, in the limit, it will look continuous. Okay, so this is all very cool, but you can say, yeah, you invented some exotic option, why should I care? So now I'm going to tell you some remarkable facts about this new option. And the first fact is that even though payoff of crossover option clearly depends on tau, on monitoring partition, and in fact, with different partitions, we have options which behave very differently, have very different risk profiles. Remarkably, their market prices are going to be exactly the same. So if I go back to this picture and say, let's say at any time, 4 variations of crossover options are traded simultaneously. Again, they are very, very different options. This is regular put. This is option which pays volatility along the strike. But they're all going to be traded at the same market price. The expectation of the payoff under Q is the same. It doesn't depend on tau.
So, Oleg, before you go too far, let me jump
Yes.
in with a question from Lars Kuhn. So the question is, why would I buy a crossover option? Am I betting on low volatility?
So we will talk about this. Yes, it allows you to trade volatility along particular strike. So for example, sometimes traders think that certain levels are special. They talk about support, resistance. Sometimes they worry about pinning risk. Essentially, they're making some statement about volatility in some local region. So this option would allow you to express those views, to speculate. So if you think that certain asset is going to mean revert, you're basically assuming that volatility will be too low or too high over particular region, and this is risk management instrument which you can use. But what I'm trying to say is that all of you already trade in crossover options because standard option is a crossover option. So I'm going to study properties of a general class, and we will learn something new about the standard options that you all familiar with. Okay, so but come back with this question a little bit later when we'll start talking about applications. So back to this kind of counterintuitive and remarkable property that all crossover options have the same market price. Why? It has to do with this certain aggregation property, and I need to explain what it means. So this is from my earlier paper in Journal of Econometrics, and we look at payoff H, its payoff function of two variables. Think X is the starting value of underlying and Y is the final value of underlying for particular period. So we pick 3 dates, TSU, which defines 2 periods. We compute payoff over this interval, take Q expectation. We compute payoff over this interval, compute Q expectation. We add them, and the sum should be equal to similar expectation for the combined interval. So that's why the name aggregation property. So I can aggregate 2 intervals, and the net result expectation of this payoff is the same. So again, importantly, this has to be satisfied for any dates, TSU, and for any martingale. So the idea here is that X represents a price of some financial asset, which under Q follows a martingale process. This is the only assumption that we are making, nothing else about the process. So continuous, it could have jumps. So for any martingale, this condition needs to be satisfied. Then we say that the payoff H satisfies aggregation property. Now, motivation for this definition is easy to see. So suppose I need to price a discretely sampled payoff, which depends on all intermediate prices. So I basically have a lot of intervals. For each of them, I compute H and add them, and this is the payoff of this complicated path-dependent option. Well, I need to compute the price of this option, and using the aggregation property, I reduce pricing of complicated path-dependent option to pricing path-independent option. So this one only depends on the starting value, which we know, and the final value. So I don't need to know the whole trajectory. I don't need to know the whole path. I don't need to know all the intermediate values for the underlying, only the final value. So aggregation property allows me to reduce pricing complicated path-dependent option to pricing some general but path-independent option. So I'll come back to this point. So here's a trivial example of H which satisfies aggregation property. It's basically log return. We all know that, let's say, sum of daily log returns is equal to log monthly return. So I don't need to know where the market ends every day. So this is a trivial example. It holds pathwise. So I don't even need to assume that my process is a martingale, because for any line, for any trajectory, this aggregation property will hold. I'm more interested in more general payoffs, which, again, more interesting than just log. So I will tell you that the class of payoffs which satisfy aggregation property is, it's restrictive. This is a very strong condition, but it has a lot of interesting examples. So the payoffs that satisfy aggregation property are rare, but they're very, very special. They play important role in the variance trading. And if you don't familiar, like the main idea in the variance trading is the following. It hinges on two key steps, key insights. So the first insight is that you reduce pricing of this complicated path-dependent payoff, which depends on intermediate values of the underlying, which is kind of very complicated multidimensional object, to pricing path-independent payoff. And then this path-independent payoff, which could be some general nonlinear function, could be synthesized by using spanning formula of Karmadan. So you will use standard calls and puts to represent, let's say, log contract. Again, the first step is the key, how to get from this complicated, how to eliminate this complicated path dependence, and this is where the aggregation property is needed. Okay, if payoff satisfies aggregation property, then this is a theorem, it can be robustly replicated. And in this paper, what do I mean by robust replication? Three conditions. The replication strategy needs to be completely model-free. In particular, it should allow for jumps. This is critical because in many earlier papers on volatility trading, the key assumption was that the process is continuous. The replication strategy should hold for any discrete partition tau. It doesn't have to be equidistant. Delta t doesn't have to be small. And the replication strategy consists of two parts. A static position in the portfolio of vanilla options and a dynamic discrete trading in the underlying on dates which belong to tau. So strategies, payoffs which allow robust replication are super attractive. So notice that, yes, we assume that we can trade standard options, those available to us, but we only trade them once at the start of the period. So we recognize that trading options could be expensive, so we don't allow frequent trading in options. So again, you only do it at the start, once. You trade an underlying more frequently, but still not continuously. Recall that in Black-Scholes, like the classical approach, you have to do delta hedging every instant. So it amounts to infinite amount of trading, infinite volume. So if you have any transaction cost, it would require infinite amount of transaction cost. Here, you trade only on finite and usually small number of dates. So again, robust replication, this is the key. This is a very attractive property, and it follows immediately from aggregation property. Okay, so I suspect that not many of you familiar with this aggregation property, and I'm going to give you a couple of important examples, which all related to kind of volatility variance trading. So let's talk about standard variance swap. So we want to have a contract which at maturity day pays you some scaled version of the realized variance. You can compute realized variance in a couple of ways. So the first one, RV1, basically takes daily log returns, square them, and computes the sum. RV2, same idea, but uses simple returns, not log returns, but simple returns. So the industry, the Wall Street, used both definition over the counter, although the first one is more popular. The problem is that both of those payoffs do not satisfy aggregation property, then do not allow robust replication. And robust replication, again, critical for path-dependent payoffs because any model misspecification immediately leads to enormous kind of mispricing, wide bounds. So those two guys cannot be robustly replicated. But there is something which is close enough. Let's call it RV3. So it's given by this expression. So it's kind of modified variance. It doesn't look like variance. It looks very strange, but it has all the characteristics of the variance. So this expression is always positive. In fact, it's quite similar to the other two guys. So it's easy to show that RV3, this modified realized variance, essentially a weighted average of RV1 and RV2 with weights 2/3, 1/3. And this is very accurate approximation to the fourth order of Taylor expansion. So this is a little picture which illustrates this. So there are three functions used to define payoffs: RV1, RV2, RV3. And the one in the middle, the solid line, it's hard to see, but it's bracketed by the other two. So this corresponds to this new modified realized variance, RV3. So what is nice about RV3, it does satisfy aggregation property. So it could be robustly replicated. And we know, so this is the result, that the market price, the value of the contract which pays me RV3, is given by so-called model-free implied variance, the standard expression where, recall, M is the price of out-of-the-money vanilla option. So we basically take puts and calls, puts for low strikes, calls for high strikes. We weight them according to weight function 2/k², and we integrate this from 0 to infinity. So we assume that we have this infinite strip of options with continuum of strikes. So this gives me this model-free implied variance, and this is the market price of realized variance according to definition RV3. So it's not, and this is the basis of computation for ideal weeks. So basically, if I have ideal weeks, all strikes from 0 to infinity, no discretization errors, then week² gives me the price of this contract. And only this contract. So the RV1 and RV2 do not satisfy this property. So basically, the industry should have traded variance swaps based on RV3 as opposed to RV1. Again, this is an old idea. I first introduced RV3 like 20 years ago, and I used it to document that there is a very strong negative variance risk premium for S&P 500 index. And I also used it to analyze hedge fund performance. So basically, hedge funds have so many different strategies. Some do convertible arbitrage, some fixed arbitrage, emerging markets, but basically they have this common property that they do well in quiet markets, and during turbulent times they lose a lot of money. So essentially, they're always short volatility. And if you count, because volatility is expensive, if you sell volatility, you earn risk premium. So if you count for this short exposure to volatility risk, basically hedge fund alphas disappear. So again, this is old paper like from 20 years ago. Now, let me give you another important example. So suppose now you want to trade not a regular variance, but corridor one. So what is the corridor variance? So this is old idea, goes back to Karmadan, and Torben and I and Maria, we wrote a couple of papers in this regard. So basically, for the corridor variance, you accumulate squared returns, but only when underlying stays between two barriers, B1 and B2. So you truncate computation of the variance, and you don't use extreme left and right tails. So in this case, there is a payoff which satisfies aggregation property. So it's given by this formula, which looks kind of ugly, but it serves the purpose. So basically, within the corridor, it is equal to RV3. Outside the corridor, it is equal to 0. And you have to be careful when you cross the barrier. So that's why it looks complicated. But the important advantage of the corridor variance is that its market price is given by the early expression, except now limits of integration go from B1 to B2. So you don't need deep out of the money puts and deep out of the money calls, which you don't see, which you don't have in practice. And this is actually how real VIX is computed. So as you know, VIX is computed as a weighted average of available strikes, but it covers finite support. So there are no deep out of the money puts and deep out of the money calls. So the right way to evaluate real VIX as the price of the corridor variance. Okay, so very quickly, this is a table which shows some other contracts which satisfy aggregation property. So typically they compute variance, but they weighted by some power of the underlying. And again, some formulas look kind of strange, but again, economically, they do exactly what you want them to do. Some special cases, A equals 0, this is our standard RV3 variance. A equal to 1, this is so-called gamma variance. Some banks offer it this type of variance swaps. This is simple variance, so introduced by Karen Corsa and then later popularized by Ian Martin. So in this case, you compute just differences in the price and compute sum of squares. And there are some other interesting special cases from this table. So this is from my older paper. And at that point, I thought that I knew all important, interesting cases of payoffs which satisfy aggregation property. But as it turns out, I missed the most interesting, the most important one, which is the crossover option. So this is the first theoretical result. And it says that payoff H that we use to define a crossover option. So remember, this is a binary variable 0, 1. 1 if we cross the barrier. And this is just the distance, price minus the barrier. So this thing turns out to satisfy aggregation property, which to me was a little bit counterintuitive because it has this kind of irregular hockey stick type of profile. So if you like visualization, this is how function H looks like in 3D. So this initial price, this is final price, K is 1. If both X and Y below barrier or above barrier, then the payoff of H is 0. But if they're on the opposite sides, then we have linear payoff. And basically we have this kind of two hockey stick diagrams, one for puts, one for calls attached to each other. Because of the kink, we have convexity, and that's why crossover option is a variance contract. And for comparison, this is how H function looks for other cases that I introduced, RV3 and simple realized variance. Much more smooth, much more regular. Again, they also satisfy aggregation property. Okay, so since crossover option satisfies aggregation property, it could be robustly replicated. So we could read out the corresponding replication strategy. Again, it has two components, static position in standard options and then trading in underlying. Well, it turns out that this strategy is super, super simple. A static position involves just one option. It will be call or put with the same strike, the one which is out of the money. Dynamic trading strategy is also very simple. It's basically invest in underlying, and it has weight either 0, 1, or -1. So every time we cross the barrier, we either buy or sell one share of underlying. And the way it goes, if we cross the barrier from bottom, so if the market goes up, we sell. And if the market goes down, we cross the barrier from top, we buy. So it's kind of contrarian strategy. So this is how it looks like on a picture. So let's say underline starts at 1 and the barrier at 105. So at this point, we buy out of the money call option, initial position in underlying 0. So every day, or like in this case, every month, we reevaluate our position. We are below barrier, so we do nothing. We do nothing, we do nothing. And this is the first time we cross the barrier. We sell one share of underlying. So next month, we still above barrier, we do nothing. And then we cross barrier from top. So we buy one share back. So it's kind of bank strategy when we always trade one share of underlying. So at most, like in this case, if it's monthly periods for annual option, at most I will trade 12 times. But as you can see, usually I trade much less frequently. And if we start above the barrier, similar intuition, we start at 0 neutral position, we cross the barrier, we buy and go back and forth. Okay, so this is basically my initial theoretical background. And now I'm going to tell you a number of new results which apply to both like high frequency crossover options, but also they will apply to low frequency standard options. And at this point, do we have any questions before I start to talk about some new results?
There aren't any questions in the chat now.
Excellent. So let me continue. So the first result, which I think kind of interesting, has to do with a new replication strategy for standard options, where we can replicate long-term option with a sequence of shorter-term options. So think about the following situation. I want to buy, let's say, 10-year out of the money put, which is not traded. So maybe I want to protect my pension portfolio for 401k. I worry about the market turbulence. So I want to buy portfolio insurance. And my horizon is long, 10 years, maybe 20 years. Well, such option does not exist. It turns out I can replicate this 10-year out of the money put option by a dynamic trading strategy where I'm going to buy every year 1 year options. Specifically, each year I will buy 1 year out of the money option with the same strike that I wanted to insure my portfolio. But the option could be call or put depending if trajectory ends up above or below barrier. So I always buy out of the money option with the same strike, but whether it's call or put depends on the path. There's also some trading in underlying involved, but basically this I can show that this rollover strategy, which buys short-term options and chain them together, gives me the same final payoff than buy and hold strategy, which buys 10-year option. And the two strategies have the same final payoff and the same market price today. One way to illustrate this result is to use this kind of slightly new idea, forward start out of the money option. So what is the forward start out of the money option? Well, it has the usual strike K, and it has 2 times, T1 and T2. So T1, this is where option activates, and T2 when the option expires. So I can buy this option today, but it activates at T1. At this point, it becomes out of the money option with strike K, But at T1, we will determine whether it's call or put. So again, if I above barrier, I will buy put. If it's a below barrier, I will buy a call. So this is the only role for T1. So with this definition, I have this nice decomposition that market price of the out of the money standard vanilla option today. So let's say again, this is 10-year out of the money put option is equal to the sum of 10 forward start out of the money options from year 0 to 1, from 1 to 2, to 3, etc. So you can think about this decomposition. The analogy is like 12 months variance swap, which I can break into 1 month forward swaps. So the value of the complete package is equal to the sum of those 1 month forward swaps. So this is kind of obvious for the variance swaps, but it turns out that the same property holds for this nonlinear hockey stick diagram of the standard vanilla option. So this is cool. Another important result is that any payoff that satisfies aggregation property and thus allows robust replication, so those are cool payoffs which allow me to, again, trade in model-free fashion, they all could be viewed as a portfolio of crossover options. So crossover option is like a fundamental building block which I can use to create generalized variance contracts just by putting different weights. So for example, if I'm interested in RV3, so I want to have this variance swap which pays me RV3 realized variance, I buy crossover options and weight them according to the standard weight function 2 over k squared. If I want to have simple realized variance, I buy equally weighted portfolio of crossover options, so each weighted with weight 2. If I want corridor versions, again, I just truncate my portfolio accordingly. So the point is that the industry doesn't have to offer all kinds of generalized variance contracts. So if crossover options are available, then investors will buy them and create risk profile that they prefer. So they will create whatever generalized variance contract they want by using crossover options like Lego blocks. Okay. If you're interested what happens in the limit, in the continuous time limit, so this is the slide. I'm not going to spend a lot of time, but basically, in the continuous time limit, the discrete time payoff process phi for the crossover option converges to the sum of these two processes. The first one is an important idea in probability theory. It's called local time. Basically, lambda measures time, how long a process spans over particular barrier. And this is a correction that I introduced. So this is correction for jumps. And so this is pure jump process. And this result generalizes earlier paper by Carr and Jarrow, which only looked at the continuous processes. And here I argue that having jumps is very important. First of all, you could have real jumps, so you have a process which actually discontinues. But also, when you have artificial jumps due to non-trading periods. So imagine that you have classical Black-Scholes settings. Everything is nice. The process follows continuous geometric Brownian motion, but the exchange closes for weekends, holidays, overnight. So when it reopens, you see completely different price, and you basically, this gap, artificial jump, this is what you need to count when you the price options on the underlying. So again, unless you have questions, I'm not going to spend a lot of time. But this is the decomposition of the time value of standard option here into two components, one due to continuous diffusion shocks and the other due to jumps. Okay, so at this point, I'm going to switch to some applications, and I presume there are no questions at this point, but maybe if
Your
people...
presumption is correct.
Okay, so I will keep going. So I think that there are a number of interesting applications, both for practitioners and academics. So first of all, this is a variance contract, crossover option. It allows you to trade volatility in localized manner. So if you worry about particular level of underlying and you think that at this point the volatility will be excessive or subdued, you can express your views by trading crossover options. You can use, as I mentioned, crossover options as the building blocks to do financial engineering, to create any profile that you want for generalized variance contract. Again, the portfolio of crossover options will inherit the same nice properties as each crossover option. So aggregation property, robust replication. I should mention that availability of robust replication strategy is a big advantage. And it means that if crossover options introduced to the market, market makers will be able to offer tight spreads. In fact, market makers are not going to do anything different from what they do now. They already buy vanilla options. They trade vanilla options or buy or sell, and they do delta hedging. And this is the same ingredients that they will need to use in order to robustly hedge crossover options. So basically, it will be straightforward for market makers to make market in crossover options. Now, I mentioned this strategy where you can synthesize long-term vanilla option with the sequence of shorter-term traded options. So you can think about insurance company which will start to sell 10-year, 20-year put options for their customers as a portfolio insurance, and use this strategy by buying standard traded liquid options in the real market to hedge their positions. This is also interesting strategy for academics because, again, you can study performance of long-term options which have not been available. You can study jumps because diffusion shocks and jumps have very different effects, different contribution to prices of options. So by looking at crossover options with different frequencies, you can disentangle the effect of the two. And I'm working on a couple of things. So I don't have a lot of time, so I will show one application, but basically one application I'm working is to dissect variance risk premium along different barriers. So basically, we know that there is this very pronounced negative variance risk premium. And previously, we could try to study where it's located for long horizon, short horizon. So we could look at 1 year option, 1 month options, maybe 1 week options. And it looks like most of the variance risk premium concentrated on the front end of the term structure. But now I can also look at the same phenomena across kind of spatial dimension for different strikes. So yes, we expect that we'll have more negative risk premium on the downside when the market goes down. But using crossover options, I can actually answer the question where exactly and what's the magnitude of the variance premium, where it is located. I have this little work on expensive put puzzle. The basic idea is that historically options appear to be quite expensive. So if you sell options, historically you kind of made good profits. But in academic literature, this argument that statistically we cannot even prove that those returns are statistically different from zero, because huge variation of option returns. And crossover options can help you to solve this puzzle, because the two have the same market price. So if one overpriced, then the other is overpriced. But behavior of the crossover option statistically is much better. So by looking at crossover options, I can basically convincingly say that, yes, historically, put options have been expensive. But I'm going to show you in the remaining time one application which uses Monte Carlo to price vanilla options. And I will use new theory to basically get a big efficiency improvement without doing any extra work. So here's the basic idea. And Dmitry, Neil, you will need to tell me when I need to stop, but basically I probably need, I don't know, 3-5 minutes to go over this example. So again, the basic idea is that, let's say I want to price standard option, but my parametric model doesn't allow closed form solution. So let's say it's Saber model. So there's no analytical solution. So my approach is to do Monte Carlo. So I'm going to simulate like million trajectories, price path, and then I will compute the payoff for each trajectory, compute average, and this is my, excuse me, estimate for the option price. Now, because I know from my crossover option theory that I can use the standard vanilla option and high frequency crossover option have the same market price. So I can use the same price history to construct a different estimator. So Vn is the estimator for crossover option with n intermediate points. And let me show you basically the picture. So basically, this is the intuition for the Monte Carlo. I simulate a lot of histories. I do a lot of work to generate this path. And I kind of waste a lot of work because I only interested in the final point. So I use this final price to compute the payoff on my vanilla option. Now, if I use crossover option with, let's say, 10 intermediate points, then I actually use more information. So I sample. So for the same history, I compute payoff by using intermediate points. And it turns out that if I compute estimator for crossover option, it will be much more efficient than if I do it for standard option. Again, I don't have to do any extra work. I already computed the whole path, but now instead of just final point, I'm using the whole history. A priori, this is not obvious because if I'm trying to price 1 year option, I kind of need to know what happens to the market at the end. So market dropped by 20%. That's all I need to know. But it turns out it helps me to know what happened to the market every month and actually every day. The more frequently I sample, the more precise estimator I get, but there is theoretical limit. So this is basically what I do in this table. I compute the price of the crossover option which is exactly the same price as the standard option, when there is only one interval, 10 intervals, etc. And I compare the efficiency. The bottom line is that I'm getting speed up to factor of 6. So again, you might not be impressed by this application because it's kind of technical and who cares about speed? Computers are cheap. But what I wanted to show that just by knowing this new theory and not doing anything extra, you will be able to basically increase efficiency of your computations. Okay, so Neil told me that I need to finish in 50 minutes. So I will try to do this. So in conclusion, this is what I do in this paper. I introduce a novel class of path-dependent options called crossover options. They have some very nice, remarkable properties. So they allow robust replication. Again, robust replication means that it's model-free, so I don't have to worry about model misspecification. Holds for any partition. There is no like discretization or jump errors. And it consists of 2 parts: static position, standard options, and discrete trading in underlying. So there are, again, by studying general class of crossover options, I can derive new theoretical insights which apply to a special case, which includes special case, which is vanilla options. Yes, and I want to conclude with this thing. So it's common in derivatives to use geographical references to denote different exotics. So we have American style options, European style options, Asian, Bermudan, Canary, Russian, etc. I think the crossover option is pretty cool. It deserves its own name, and my proposal to call it Ukrainian for a number of reasons. And I'm going to stop at this point and looking forward to your questions. So this is the paper if you want to read it. And I have a lot of stuff in my appendix, but I'm going to stop here.
Great. Thanks, Oleg. So now anyone who has a question is welcome to shout it out, is welcome to unmute yourself and shout it out.
I did just that. So thank you, Neil. And thank you, Oleg, for a great presentation. As clear as usual, if not even clearer. That was very nice. 2 questions, and I'll just give you both, and then you can take time to respond. So in terms of measuring where the volatility risk premium lies across the strikes, that's, of course, very interesting, something we've tried to do before with the corridor volatilities and up and down and these things. We also done other work with I've done other work with other authors to try and figure out whether the tails matter for these things, and it does. I think the idea is great. I think the practical problem is you still need to have the option quoted, I presume, at the extremely far out of the money options in order to do the calculation. That's kind of a question, I guess. And on top of that, for those options, even if they are quoted out in the extreme tail, the spreads tend to be quite dramatic. So even identifying what the right price of those guys are is an issue. So I don't know if that puts a limit on what you can achieve empirically. I love the idea, but it seems to me it runs into kind of the usual stuff with the tail being difficult to observe, and that probably is very important for the variance risk premium. The second question is the temporal building of whatever option you want to achieve, whatever variance contract you want to obtain, is a kind of a Lego construction of crossover options. Sometimes it seems to me it might warrant a lot of crossover options, which means the trading cost might go up, and you need to then, if you're sampling discretely, do more transactions in the underlying as well. You have to do one for each of the crossover options, but maybe that's not a problem. So in terms of realistic things that you might want to replicate, would there be a lot of crossover options involved, and how would the transaction cost potentially be? That was the second question.
Okay, thank you, Torben. Great question. So the first one, correct. You need standard options in order to synthesize crossover options. So if you're really interested in really out of the money tails, left tails, right tails, yes, you're going to depend on the standard options. But my idea was that, like for S&P, you already have coverage which goes from like minus 30 sigmas to plus 10 sigmas, right? And you basically say, well, at this point, we traded variance as a package from 0 to, let's say, 1 year. And we know that historically, it had a very strong negative variance risk premium. So we know how to dissect it in time dimension. So you basically say, oh, okay, let's look at forward variance swaps from 0 to 1, 1 to 2. And again, it appears that most of the variance risk premium is concentrated on the front end. But now I'm suggesting that I can do dissection in time dimension and in space dimension. And I want to see how much risk premium, like minus 20%, minus 10%. Yes, there is a limit. As you know, I prefer to work with the corridor versions, basically saying that we don't know the truth in the extreme wings, but we could have a very detailed picture, at least from minus 30 sigma to plus 10 sigmas. So I want to see how this profile, the signature of the variance risk premium change over time. So with invention of zero DTE, it appears that there is this compression. The variance risk premium starts to move closer and closer to the front end, but also there is probably movement in this kind of spatial dimension. So I just want to, now I have a perfect tool to answer this question. But short answer, I need standard options in order to analyze crossover options. They are kind of two brothers, big brother and little brother. They're intimately linked. They have the same market price, and one is hedged by using the other one. So if there are transaction costs, if it's expensive for standard option, it will be inherited by crossover option. So that's fair comment. But the flip side, trading of crossover options will be as easy or as difficult, whatever your perspective, as standard options. So in this sense, they are kind of equivalent. And that's why I think it will be relatively easy for the industry to introduce them to the marketplace. Market makers will not have to do anything different from what they already do. And sorry, remind me of the second question.
The second question had to do with whether you would need to do much more trading if you have, I don't know, 50 crossover options to replicate something.
Oh, okay. So basically, again, those Lego blocks, the cost of trading will be exactly the same as trading regular options. So if your at the money option has trading cost, let's say 1%, then your at the money crossover option will have the same basically transaction cost. As you go to wings, transaction cost spreads will, in relative terms, become more and more important. But I claim that right now, the industry offers a lot of over-the-counter variance contracts, custom tailored, generalized, and those, some of them are not robustly replicated, so they're model dependent. And as a result, investment banks basically put higher and higher, spreads, right, to compensate for this model uncertainty. So crossover options are the cheapest, most efficient variance contract. So you offer the menu of crossover options and let people to decide what exactly they want to do. Corridor ones, down variance, up variance, simple version, gamma version, etc. So I think this is the most efficient way to trade variance.
Thank you.
By doing financial engineering by doing pieces instead of the package.
Thank you.
Sure. Thank you.
So for these long-term options, right? So can you compute the price right away, or do you have to wait? Like if I want to compute 10-year options on S&P?
You have to wait. So I mean, here's one application based on this idea, and maybe it will appeal better to you. So consider 2 months option. You have the price, right? And I say that I could also recreate this 2 months option using 1 month option. So today you buy 2 months option. This is buy and hold strategy. And then you have rollover strategy. You buy 1 month option, and then next month you buy another out of the money option. It will be call or put. You don't know. The theory says that the two strategies must have the same price and they have the same payoff. So this allows you to check whether 1 month options are priced consistently with the 2 months options. So this is you can run on our standard data and basically see, like, it's possible that both 1 month and 2 months are expensive. They are kind of overpriced. But it's also possible that one is more expensive compared to the other one. So you can do this relative comparison. So in this case, because I observed prices of both short-term and long-term option, I could do this comparative study. For the options which are not traded, like 10 year, 20 years, yeah, you don't observe the price, but the theory says that if they traded, that would have been the price.
So an equivalent way of saying that, just following up on the question, is Torben again, is that the expected price, you know what the expected price will be, but you don't know what the realization will be. You
Exactly.
have to wait
So,
to see how expensive those options are in the future. On average, you will be right, but you might be disappointed and pay a lot more, or you might be lucky and pay less.
Exactly. I have discussion about this point in the paper. So basically, this is a replication strategy, but it's not self-finance. It's actually dependent on actual trajectory. And initially, you could say, oh, this is not great, but my point is that self-finance strategies is theoretical fiction. They do not exist in real life. So yes, in Black-Scholes, assuming that you can trade instantaneously at every second and assuming that you can have this infinite transaction cost, you can try to do this. And then for each trajectory, you always have this deterministic value for your option. In practice, you have to do it discreetly. So all strategies are not self-financed. So there is some risk involved. Same here. So you will depend on particular trajectory. So you might be disappointed. But if you are, again, insurance company, and you sell a lot of those long-term portfolio insurances, this will be like statistical arbitrage. Those surprises for different clients will cancel each other. So on average, this strategy will work. On average, it gives you the expected price. So yeah, sometimes you will be pleasantly surprised. Sometimes you will be disappointed, but on average, you will do just right.
So there's a comment, not really a question. There's a comment from Catherine Shalin in the chat that you might want to look at.
And we'll try to do. Okay. Yeah, I mean, this is a great comment. I agree. So as I said, for example, variance swaps recently, like just last fall, SIBA introduced futures on realized variance. Well, they should have defined their payoff based on RV3 payoff, which is based on, which satisfies aggregation property. Again, economically, it does essentially the same thing that the standard realized variance, but it has huge theoretical advantages. And again, helps market makers to hedge their risks. So yes, often industry bypasses efficient solutions, but we should still try to convince the industry to do it the right way.